What if you could build an investment portfolio that doesn't rely on predicting the economy, but actually works in any situation? High inflation, recession, or booming markets, you're covered. Most investors try to guess what happens next: interest rates, inflation, growth. But smart investors don't predict, they prepare. And that's exactly what this strategy is about. At its core, a strong portfolio isn't about finding one perfect investment. It's about combining different assets that perform well in different conditions. Think of it like this. Some investments grow when the economy is strong, some protect you when markets crash, and some help you survive inflation. When you combine them properly, your portfolio becomes more stable and more reliable. Let's break this down into 4 simple parts. First, growth. This is where your long-term wealth comes from. Stocks have historically been the biggest driver of returns. A simple way to do this in the UK is through global index funds like the Vanguard FTSE All-World ETF or the HSBC FTSE All-World Index Fund. These give you exposure to thousands of companies around the world. Over time, as businesses grow, your money grows too. Second, bonds. Bonds help stabilize your portfolio, especially during market downturns. Examples include UK government bonds, also known as gilts, or global bond funds. But here's something important. Long-term bonds can be risky when interest rates rise. That's why many investors now prefer shorter duration bonds, which are less volatile. Third, inflation protection. Inflation quietly reduces your purchasing power. And in the UK, it has historically been higher than in many other countries. To protect yourself, you can include assets like gold, commodities, or inflation-linked investments. These tend to perform well when inflation rises. Fourth, cash or short-term funds. This is often overlooked, but extremely powerful. Short-term money market funds or ultra-short bond funds adjust quickly when interest rates increase. In recent years, they've even outperformed traditional safe bonds in certain conditions. So what could a simple portfolio look like? You might have around 50% in stocks, 20% in bonds, 15% in cash or short-term funds, and 15% in gold or commodities. It's not about being perfect, it's about being balanced. This approach works because you're not relying on one outcome. You reduce large losses. And most importantly, you stay invested for the long term. Historically, a balanced portfolio like this can deliver around 5 to 6% returns above inflation over time. But more importantly, it avoids the kind of big crashes that make people quit investing altogether. If you're investing from the UK, there are a few key things to remember. Use a stocks and shares ISA to protect your investments from tax. Consider a pension like a SIPP for long-term wealth building. Rebalance your portfolio once a year, and always keep your costs low. At the end of the day, you don't need to predict the economy to build wealth. You just need a system that works, no matter what happens. That's how smart investors think. And if you want simple, practical investing explained for the UK, make sure to subscribe and start investing smarter today.